Hello, everyone, and Happy New Year. Welcome to Start the Year Off Right, New Year Financial Planning for Law Firms. I am Natari Mom, immediate past president of the Beverly Hills Bar Association and current president of the Beverly Hills Bar Foundation. I'm delighted today to introduce our speaker, Mr. Derek Barto. Derek is a CPA and principal consultant at Barto Consulting, LLP, advising law firms on improving financial performance and strategy. With expertise in finance and accounting, he helps firms manage key areas like partner compensation, risk reduction, and compliance. Derek also assists in improving finance functions, systems, and processes. Before founding Barto Consulting, he was a partner at Armanino LLP, where he led outsourced finance services for law firms. He has a bachelor's and master's in accountancy from Wake Forest University and a master's in law firm management from George Washington University. And now let's get started. Derek, the floor is yours. Thank you for being here.
Thank you for having me, especially for such a riveting conversation and getting ready for a new year. And thank you everybody for attending or watching on video. I appreciate your interest in the topic that's very near and dear to me. And if you do have any follow-up questions that you can't get across here or as you're watching the video, please do feel free to email me. My contact information is in the deck. So as Dira had mentioned, I am a CPA and specialize in financial management and consulting for law firms. I know that can mean a lot of different things, but helping to make firms more profitable and better able to capitalize on opportunities. So with that, we go through this presentation on New Year financial planning for law firms and what you should all be doing to really get ready and capitalize on the new year. So with that, I will share my screen and we can start going through this presentation. Okay. So today we'll talk about a few things. We're going to talk about at the end of the year, evaluating your prior year performance and what you should do, what that should look like, and a couple tips in going through that to make it a lot more effective. Projecting income and cash flow for the year, and then identifying potential pressure points for the year to come. So starting off and evaluating the prior year performance, you really want to review a couple things. A lot of firms that I will work with really pay a lot of attention to their income statement and their income as a gauge of how last year went. But that's not the only thing that you should be looking at. You should be looking at your financial position as well, which a lot of it is your cash position, but it's also other things that will turn into cash or require cash. So we'll talk through some of those in the coming slides. But first, you really want to ensure that your books are reconciled and timely. Now, if you're a smaller firm or a solo, this is really a lot more attainable than you may think, especially with the software and tools that are available to firms of many sizes in QuickBooks and Clio and the tools that they have embedded in them. You should really be looking at your books. I say it and you may laugh almost daily, but I mean, it is really, really attainable with the tools that you have in the AI functions. And that's not scary AI. That's basically you connect QuickBooks to your bank. It tells you what it thinks the transaction is, and you tell it yes or no. If not, you tell it where to put it. And I run many different firms and generally will do the accounting daily. You miss a day or two, but I do it daily, and it's just comfortable because then you know what you're looking at and you have a sound understanding of your financial position. So when I'm saying it needs to be timely, I'm saying by January 15th. So right around the corner here, you should really have a good understanding of your income and financial position for not just all of 2025, but really by the end of the prior month, or you should be able to see through the prior month. So on December 15th, you should be able to see November at that time. That's just really standard. And it gives you the ability to really assess it and do it efficiently and understand if it's correct or accurate. And you're there in real time, so you really understand the transactions that are happening, and the context is very strong. Whereas if you're looking at it even January 15th, but looking back at last January, you're going to have a little trouble seeing if the information is even relevant to you. So in doing that and making it timely, it really improves the quality of your information. And that is what we really need to look at. That is how you run a better business, is when you have quality information. Uh, I define that as timely, accurate, relevant, and consistent. Um, I do not define that as detailed. And do not mistake accuracy for detail. Detail is actually really the enemy of accuracy because there's so many nuances that are often distracting. So when you're really looking for quality information, timeliness is key. Accuracy of really the big ticket items is so very important. Relevant information means, do I really need to look at this? I mean, is this something I want to see if I'm running a small firm? Do I want to see every billable hour for every attorney on every client? No, I'd like to see a summary, maybe a summary by client, or maybe just in total. How do we do this month? So that information is relevant to me. So really defining it as you go through this process is super helpful and super important. And this quality information helps you better get timely insights and use the information that is coming from your accounting system, or if you're a slightly larger firm, your accounting department. The last bullet here, consistent and familiar, is also important. You should really be looking at the same things every month, and it shouldn't be new every time. And I think that you may not realize the importance of that and the value. As Dira had mentioned, I ran the outsourcing group at my prior firm. And when I really started to get a hold of the department and run things, and this was a large department, multiple $1 million of revenue, lots of people working from various different departments. When I really got a handle on it, it was when I was able to refine my monitoring and what I looked at into a handful, 4 or 5 different metrics and different pieces of information. So we're not looking for quantity here. We're looking for quality and familiarity, and just knowing that what I'm looking at helps me make the decisions that I need to make to better run the firm. One thing that I will say is really challenging when you're talking about this, timely information and accuracy. There's a lot of buzz about the integrations with QuickBooks and Clio, and I see many firms not just spend so much time implementing it, but also spend so much time fixing it, correcting it. And I personally, as an advisor and as a user, I shut those off. I do not feel that they help contribute to quality information whatsoever. And the benefits that they have and how they record things in both systems really, to me, can be done a lot of different ways that are much easier and help to get your information to a higher level of quality. So I would recommend, if you're thinking about integrations, that you think twice. Where do you really need your accounts receivable ledger? Well, if it's already in Clio or another system, do you need it in QuickBooks? Now, there's some requirements on trust accounting that you need to navigate as well, but you can navigate those differently without having this hornet's nest that sometimes delays financials for months, if not longer. And so getting your financial information is key, and driving efficiencies through the integrations does not always pan out the way that you want it to. So back to the conversation at hand, when we're looking at income and financial position, what does that mean? Well, your income is how much you've earned after expenses in a given year. Your revenue minus your operating expenses, salaries, rent, etc., equals how much you made. But your financial position is really what's left and what form is it in. And I have, cash position it equates to financial position, but it's not always, synonymous. because you may not have cash for things that you've had to pay that clients are going to pay you back, right? You've loaned your client money when you've paid the expert and put it on their bill. So your financial position includes your cash and your other assets that are going to liquidate pretty quickly, your current assets. Um, the other side is true is where you have to really understand your short-term liabilities. Sometimes if you've got retirement payments that you need to make for your employees, those are going to come out of the account relatively quickly, and so you need to take those all into account. So looking at both of these is important. And my little note here is so very relevant as a tax advisor and a law firm financial management consultant. uh, Tax is based on your income. So your income tax is really driven by what your CPA sees on the income statement. Now, if there is something that is reflected as an asset or a liability that really shouldn't be there, well, that may impact your your income. And so if you're communicating with your accountant as you should be in advance, they may be relying on numbers that aren't exactly correct if you haven't also looked at your financial position. What you might see, especially when I'm talking about these integrations, is undeposited funds that are sitting there on the balance sheet that got pushed over from an integration, unapplied cash payments that for some reason are unapplied and not showing up as income to you, even when they should be. They're sitting there on the balance sheet or your statement of financial position, and they really should be income. And so if when you fix this or when you send your entire books to your accountant, they may say, oops, you you have $100,000 more of income that you didn't know about, which usually that's good. It's good to get $100,000 more of income, but when you're not expecting it, then it can cause problems, especially if you've already used the cash. So then all you have with that is the tax, the tax that comes along with that income item, which is not as excellent as $100,000 of income. So, uh, keeping that in mind, you really have to look at both things to really assess how you did last year. And so once those are clean, you've got reconciled financial statements. Your banks are reconciled. You've looked at your balance sheet statement of financial position to really assess what cash you have, what assets you have that may turn into cash, and you've been able to really see clearly that you have a clean set of books and it's reflective of of your performance for last year. Well, then what do you need to look at? When you are looking at that, you should be able to look at your books and say, what are my most impactful expenses? What are the things that I spent the most money on? Do they make sense to me? Am I really sure that these are in the right place? Is there anything else that I want to know about these that either should be in here or I should make a note to follow up and check, right? And what we're really trying to do is assess how last year went. One, because we're curious and we want to know. Two, we want to kind of replicate it or do something differently in the current year, or in the year that's coming. So we're really using this as we review prior year to gain insights as to what we're going to do for next year. So was your year successful? What are the causes and how do we replicate them? So I think the main theme when you are looking at this, and I hope the presentation and my delivery really emphasizes this, is things need to be simple. Right? We have to have a level of simplicity. If it's not simple enough, make it more simple. And we'll talk a little bit more about that because having information that you can evaluate, right? By setting an expectation and then by having information that you can use to compare to those expectations, you can then critically evaluate what's going on with your business. So I don't care if your office supplies are coded to office expense and that's wrong or your subscriptions are there and shouldn't be. It's like, I really just want to be able to evaluate something. And if it needs to be really simple and you can look at two or three things, well, then do the two or three things, but don't throw the baby out with the bathwater just because you have all these, subscription expenses or these little items that are flowing through that are just noise. Eliminate the noise. You really have to structure your financials so that you can use them quickly and easily. And that's why when I say timely and you're really looking at them every day, you do get into a cadence as long as it's simple. So getting very, very detailed about how things are coded might be problematic, right? So you generally want to roll them up into groups and look at things in groups and then dig down. If questions arise, as they often do, you can get the additional information, but start with big picture, right? And again, we'll go through some of that. So that's what you're looking at when you're looking at the prior years. Can I get this quickly? And what does it mean for the coming year? Now, just a note about how law firms track their financials. You probably hear cash basis. You're on a cash basis. For tax purposes, you're on the cash basis. However, not everything is just recorded at, all cash in is not income, all cash out is not expense. And so here, when you say cash basis, you really have to think of it in terms of earned versus received and incurred versus paid. So the two main ways to account for things, and when you have larger businesses and companies, they generally will operate on the accrual basis. And on the accrual basis, there's a lot of differences and people make professions out of it. But generally, the difference between the accrual basis and the cash basis is going to be income on the accrual basis is recorded when earned and expenses are recorded when incurred. On the cash basis, that is not the case. Revenue is recorded when received and expenses are recorded when paid. And so that's the main difference. You still have, if you purchase a fixed asset, something that's going to, last you for 5 years, well, you still have to what's called capitalize that, which means you don't deduct it as an expense, and then you expense it over the next 5 years. And so that shows up as an item on your statement of financial position when if you pay $5,000 and you don't deduct it, but each year you're going to take $1,000 deduction. There's something sitting on your balance sheet or statement of financial position that will reflect that. So it's still present in the cash basis. So that's one thing that you really want to make sure to understand as you're evaluating this. Your income is not always going to be your cash. And just because you're on the cash basis does not mean that you only have an income statement and every dollar that comes in is taxable and every dollar that goes out is a tax deduction. That is certainly not the case. So something to keep in mind as you're evaluating the prior year, and that may complicate things a little bit, but use your judgment as you're looking at your financial position. If you see a big unapplied payment on your books, you have to understand like that may not be right. And so that just critical thought and knowledge, high level knowledge of the basis of accounting that you're using can help you better analyze this and really evaluate how the last year went. So why do we care about last year? Well, simply because we want to know what's coming. And that's really what it comes down to. When you're talking about a projection or a budget, it can sometimes seem daunting. When you have many things to think about that you don't know, many unknowns out there, many things that you may not be familiar with, you have to be able to just get a handle on it in some way. And now, when we work with our clients, we have many different ways that we look at things. We do very detailed analysis. We're looking at the subscriptions that we're paying to make sure we're not paying too many. We're looking at our pricing on our insurances and our risk management, looking at leases and space and people and their efficiency and effectiveness and what that means to the bottom line and percentages and profitability and different views. And it, oh, it's not really the way that you should do it. We ultimately get there, and we've been doing this a long time, so we are comfortable in looking at it that way. And when you're not comfortable, there's other ways to do it. But even us, as very comfortable professionals, will ultimately boil it down to what's our monthly nut and what do we need to earn to cover it and make the desired profit that we want to make. And so, at the very least, if you can do a budget of what's my nut, how much do I want to make, and what revenue do I need to cover that, that's enough to start. You will refine it, but as long as you have it set up so that you can have that learning loop, you can do things. You have your expectations, and then you compare to the actuals. That's why the timely financials are so important, because you then compare to the actuals that happened during the month, and you say, this wasn't what I expected. Why? Well, a big client didn't pay. Okay, they'll pay next month, no problem. Or, holy cow, we don't have enough work. We have too many people. Let's dig into this a little bit and let's check things. But ultimately, we have that just high level starting point to really gravitate to and set our expectations around. And so that is the most important thing, because you need to be able to adjust, right? When you have unexpected results, when you have opportunities that you want to capitalize on, to be able to just have this structure in which to make those decisions. That's what helps to start planning a really successful year, and something to look at, even if it's very, very simple and rudimentary. You really should just start doing something. And the theme here, as I said, simplicity. That keep it simple. If it's overcomplicated, simplify it. There's no great magic to this. You really need to have it done. It's way better than perfect, and simplicity will be your best friend in doing this. So how do we make it simple? Well, start early, and for smaller firms and even for larger firms. This is just stuff you should be thinking about going into next year. What are my taxes, right? What do I think I'm going to make this month, this year, this however long? Where's it going to come from? How much business do I need to get to do that? These are thoughts that I'm sure everybody is thinking. So when you're budgeting, you just can write those down, right? You make the budget measurable and easy to compare to actuals. The tip that I just gave you around simplifying it helps with that. It's really rooted in that, because you're just going to pull your hair out. Case in point, if you are trying to chase down every little expense, really make it easy to compare to the actuals. And if that just means looking at total income versus total expenses, and that works for your firm, then that works. You just need to be able to compare it easily to something and operate quickly. Getting a little more detailed, the use of groupings are really important. And so as you expand into larger firms, or just want to do things differently, generally at the detailed level, you're dealing with transactions. And now there's no rhyme or reason, there's no magic or prescription to how transactions are recorded. There is definitely a rhyme or reason, but it's not set in stone. Office expenses don't have to be coded with other office expenses. Why? Because maybe I want a certain vendor to be broken out differently, and I just do that, right? And these transactions can go into the accounts that I wanted them to go into. And I generally don't like to expand my accounts, those who work with me, both clients and internally here in my firm, know that if they're going to add an account, for me, it's like pushing a rock uphill because I want to know every single thought process around it. I do not want more accounts. Now, you might, and that's okay. Why? Because you can be as detailed as you want in your record keeping. You can put all the accounts how you want them to be. It does take sometimes a lot more detailed focus to be able to get them right. But ultimately, you can roll these accounts up into groupings. So you summarize them into groupings. You do this either through your system. If you are familiar with QuickBooks, you know that there's different groupings and categorizations throughout the chart of accounts. So you can actually look at things in a different grouping. And we actually break them out and manage our own groupings just because it's so strategic. And so you can have your transactions in any accounts that you want. I like to keep them very limited because I rely on the accounts somewhat in analyzing my day to day. And sometimes I will break them out for specific vendors. But ultimately, when I'm looking at things, it's at the grouping level. So kind of that middle level so that I can see trends and look at things like how does this compare to last year? How does this compare to my expectations? And based on what I've budgeted, what's the rest of my year going to look like? And is that in line with my expectations? So that grouping level for me is where I spend most of my time. And then when we roll it up further into the budget, we're really looking at everything together. And that's kind of the financial performance or the income, along with the other financial performance, which really generates a cash flow. So not only am I seeing kind of how I expect to perform when I'm budgeting, I'm also seeing what I expect my cash to be because I want to make sure that if there is income, I can pay it out to partners and those who have earned it are going to get it in some way, and if not, I can communicate accordingly. Now, this last comment here to budget based on only what you are able to measure. Uh, it sounds funny to say. It kind of sounds like the tail is wagging the dog here, but I find myself changing my behavior, and when I start to do something and when I implement new processes, like when I'm tracking client costs, that's a very difficult thing to track depending on your practice area and the volume. How do you know you've got people who aren't involved in finance ordering things from vendors? And oftentimes they don't need approval. It's small, amounts and first legal, and there's many different examples of how this can happen. But ultimately, you've got people outside of the department ordering things that I am then to pay, or they put on a credit card. And the question is, how do you control this? And how do you plan for something like this? And how do you budget for it? So the process that we implement around what we ask people to do is really based on how are we going to be able to track this and make sure that when we come back and we have to look at all the checks that went out to the vendors, look at all the bills, look at all the credit card statements, make sure that they're on the bills, match that to all the cash payments and everything that we need to do. Well, we certainly need people to do things a certain way because if we are then following their lead on it, it's going to get really crazy really fast. And that's a pretty complex example, but it really does exemplify why when you budget, you do it based on what you're able to measure. If your credit card statement doesn't provide certain information, well, don't plan your budget around that information. Work with what you got. And that will lead to faster information, more accurate information, and you can deal with the shortcomings on that end and gain a lot of traction and benefit on the budgeting and planning end. And then you can do something about it. You don't have to grind everything to a halt just because one thing doesn't work. If you can change and adapt, and as you learn from this process, you are then able to realize what works and what doesn't and change accordingly. So I would really recommend starting simple, using some of these keys, starting early, getting good, timely information from your system, understanding what you're looking at, and making sure um, to really apply some critical thought to your budgeting and planning process, because that's what's going to allow you to kind of see month by month, quarter by quarter, what's happening. And so as we move into the next part of the presentation, that's going to help you to navigate a lot of these pressures that impact law firms. And it's in this mid-size law firm, mid, small, solo, man, there's a lot that you have to navigate, and knowing what's coming and having at least something that's relatively correct or reliable um, is just so valuable. Larger firms will generally be doing it with more sophistication, more accounting power, and people in the accounting department. And even then, it's very, very challenging. But same advice to everybody is keep it simple. Just get your eyes forward and know that you have a lot to plan for when it comes to these things that we'll talk about now. Pressure points on the year to come. So there's a lot of things that make a law firm tick. All right, you've got to get clients, you've got to get attorneys, you've got to figure out all these complex situations, how to win your trials, how to advise on the best transaction. It's hard. Um, and then it just gets harder when you're dealing with all these other things where it's really a financial infrastructure that drives these things. But you as an individual still, even if you don't have a sophisticated finance department in the back office, you're going to have a tax payment, and it's going to be big. And that's just the way it goes. We all know that. It is generally going to be any individual's biggest expense, give or take. But even if it's not the biggest, it is large. I have worked in public accounting for over 20 years now. And I will tell you that most people do not budget or plan for this. They rely on their accountant to tell them what they owe, sometimes quarterly, sometimes in April. And no matter what, it is uncomfortable. And it is a really tough time when you have no idea what these payments are going to be. So my advice is you really need to budget and plan for this. And I will tell you, I was a tax accountant for many years, preparing individual taxes, business taxes. Now I focus more on running the law firm. And really, because of this, is you need to know what's coming. The conversation with your accountant really needs to be about not just what I owe now this quarter, but what does that mean for the entire year? If an accountant can tell you what to pay now, the accountant can tell you what to pay next quarter, the following quarter. That doesn't mean it's going to be perfectly accurate, but the information is there. It's based on assumptions. If you're paying something now, it's based on an assumption that can be related to future quarters. So knowing that information for your taxes and then being able to say, okay, where's the cash flow coming from is very important. How do you do that? Well, a good budget and a good view of what the year is going to look like will help you do that. You can communicate to your accountant. This year, I expect to make more than last year. Okay, well, here's how you're going to pay your taxes. You only have to pay 110% of your last year's tax because you're going to earn more. But then in April, you have to make sure to save this money, and you have to make sure that that is available to go in. Great. Let me pull that in and see if I can fit that into my distribution based on how I expect the firm to operate and the firm to run. And so your expectations really starting at the, hey, what clients are coming in, really hit home when it's how do I make my tax payment based on what I've told my accountant. Come the middle of the year, it's, oh, I've made significantly more than last year, more than I thought. How do we adjust? Okay, well, nothing to do now because you're higher than last year. However, in April, you're going to owe a lot more. So just make sure you're saving that money. These kinds of things are just helpful to know. Again, it doesn't have to be accurate. It doesn't have to be perfectly on the nose. It just has to be close enough, something to manage. And if you know it ahead of time, you can react. It's not a fire drill. And part of our mantra as we're running firms is we're really managing them 3 and 6 months ahead. And that's really how you should run a law firm. So all this for us really hits home. And this is really what it comes down to. This is the personal aspect of, of a law firm consultant is make sure that I'm not super surprised by my taxes. Help me find the money to pay them because this business gets complex. It seems like it's simple, but it's fairly complex. Speaking of complexities, what drives a lot of the complexities that we see as far as taxes is phantom income. So, phantom income is as eerie as it sounds. It is taxable income without the cash to pay it. For example, if I earn $600,000 and I have $100,000 of phantom income, well, that means I only get $500,000 of cash. With that, I need to pay my taxes on the $600,000. And then after that comes out, we'll call it $150,000. I have $350,000 left. And with that, I need to run my household. I need to pay for colleges. I need to make sure that I have savings. Can I do that? So, phantom income, if you don't know it's coming, is amazingly impactful. It is extremely negative. If you know it's coming, it's still not comfortable, but you can manage and plan for it. So it's one of those things when you're budgeting, if you're looking down the road to next year or the end of the year, say, oh, we've got this huge trial. Our client pays after 90 days. We're going to have to advance some expenses. So we're going to be out $100,000 at the end of the year. How do we plan for that? Well, I need that money at the end of the year. We're going to earn it. I need it. How do we then fill the gap? Well, maybe we can get a line of credit and finance our case costs. Perfectly normal. It's a very healthy, a very healthy thing to have for a law firm. I recommend that all law firms for managing phantom income have a line of credit, even if you don't think you need it, even if you don't use it. To me, it's an insurance policy and it is really essential because when you need it, they're hard to get. When you don't, they're easy. So again, insurance, you need to have it just to make sure that you can manage some of these kind of ups and downs. And the line of credit comment doesn't even relate just to managing phantom income. It's also capitalization. You may not realize, but if you leave money in your firm as a capital contribution and don't take it, then you don't have it to pay taxes. So it is phantom income. A line of credit lets you manage your firm with a little more confidence and a little more comfort, knowing that, hey, if a big client doesn't pay, I don't have to just empty my bank account or fund the firm out of all my savings. I have a little cushion to manage some of the swings of the business, and I don't have to keep my capital reserves as high. I was talking to a three-partner firm the other day, and they had $2 million of capital, and they were dying. They had $2 million because they had large swings in their business, there was volatility, and they couldn't get the right financing. And so it is so important to have a line of credit, especially as it relates to managing phantom income. Well, what are the causes of phantom income? I mentioned advancing client costs. That's a really huge one. Repayment of this debt. If you borrow on a line of credit one year and don't pay it back, then the next year you've got to pay it back out of your taxable income. So that same thing applies. You've got taxable dollars that came in that you used to fund something that wasn't tax deductible. Therefore, you've got phantom income. Same thing applies to non-deductible expenses. Here, it's entertainment is the main one, but meals also 50% of meals are not deductible, life insurances, club dues, or anything of that nature. That all leads to phantom income. Some of them are timing differences where with debt you borrow, and so you have the opposite of phantom income when you actually borrow it, is you have access to the cash without the tax implications, and then you have the phantom income when you repay it. That's a timing difference. Um, the non-deductible expenses are not, they are just statutorily not deductible. So now the last and most important thing that I've kind of touched on a little bit in this presentation is the partner compensation aspect of budgeting and planning. And so if you've got multiple partners, it's really hard to have a compensation structure that works unless you're just doing a straight percentage split, which I will tell you, those are going by the wayside more and more just for a number of reasons. But as somebody who sees a lot of compensation structures, those are the ones we usually go in and change because ultimately things change too much for a percentage structure to really work and work well. So with that, you need to manage your partner's compensation structure. And managing that is a number of things. It's not only budgeting the income and expenses for the firm, but how those will then be split, right? And how that you need to have knowledge of your system and be able to understand all these components of it. So when you are looking at your origination credits and client performance and books of business, you need to get some insight into those. So as part of your budgeting process, that plays a really significant role. And so when you have a system that deals with origination credits, you really have to do a little more planning and communication from your partners. Hey, what do you expect for this year? Because when you pay out the money, right, on the left-hand side here on the screen, you really need to pay it out. And the key is not to over distribute. So you need to pay it out in different tranches. People usually will need some money to live. I've seen some firms that set that amount very, very low. But generally, you need some money to live, you need some money to pay taxes, and then you'd like some excess as a distribution of profits as you go through the year and have a successful year. If you are not tracking your origination credits and the components of your compensation structure and budgeting and planning for those, then it is very, very difficult not to overpay and still pay, monthly draws that people want. Generally, when you're paying out monthly draws, you're going to pay 40 to 60% of what you expect somebody's total compensation to be. That depends on your practice. So I know that's a wide range already, but some practices will not pay much at all monthly because the income comes in big, big tranches. And so there's a lot more kind of other distributions that are paid out to offset that. But in general, you want to be able to pay a reasonable monthly draw so that partners can pay their bills. Well, if you don't know or don't have a reasonable way to expect what your origination credits will be for the year, then that becomes problematic. So in many firms, there's conversations before. Some are more sophisticated than others or more exact than others. Some are, hey, where are you going to land? And there's this trust and rapport over the years that's come up or that's been built. And so, okay, I know where I'm going to land. If I'm tracking, if I'm not tracking, we'll have a conversation a little later in the year. Others will be a lot more specific of, you are basically putting in your business plan and your origination credits and your client performance is really going to be paid out based on what you expect. So if it's not happening, it's a bigger problem, especially if it's not happening with any client as opposed to your portfolio of clients. So managing those is something that is done up front, but then the important part is when you do have that type of compensation structure, you need to look at the budget and you need to look at the performance against their commitment, the partner's commitment, and their anticipated book pretty closely, because you do need to adjust those. So generally it's going to be about quarterly. So we set the monthly draws pretty low so that we're not paying out too much cash, and we don't have as much of a risk of overpayment. And then quarterly, we are looking at the performance against the initial assumptions, the initial plan for each partner or participant in the compensation structure, and determining, okay, how likely is it that they're going to meet their goals and what we had planned on. And in looking at that, you can adjust or adjust the comp calculations, but also adjust the quarterly amounts that you pay out. So your quarterly mechanism is a way to say, okay, in the first quarter, we're not going to pay out too much because we don't know. There's a lot of risk and volatility as to what's going to happen. So we're not going to pay out a ton in the first quarter distribution. By the second quarter, we'll have a lot more understanding of how each partner is performing. And so we can slot that into the compensation structure with a lot more certainty. We have 6 more months on our budget. And so we have a bit more certainty as to how the performance of the firm will be going. So with that, we are able to then adjust these quarterly distributions. And then the annual and other distributions are made really as closer to the end of the year, usually fourth quarter, December even. Sometimes they're even made after the end of the year if you're a partnership and can defer your payouts of profits until all the books are in. That's often done. And it's just a matter of balancing how much cash you're keeping on hand versus putting in the pockets of the partners, balancing this risk of not paying out too much to partners. The money is very, very difficult to get back. And even if it comes back, it's just a bad look. So the key that we really want to focus on, and that's the box to the right, is you want to pay out enough so that the money is not just sitting there building up, not earning, what the individual partners who will ultimately get this is wanting, would be earning on it, but also not pay out too much to where you over distribute. So many systems, or most systems that I see now, do have performance included in them. So especially in mid-sized firms where you're really looking more at profitability of certain partners, certain practice groups, and with the financial tools and data that we have nowadays, that is just becoming more and more prevalent. This is a little bit of a tricky navigation, and it starts with a good financial budget, right? You can get the client information, as close as you can get it. And sometimes you can get it spot on if the partners are really in touch and attuned to what's going on with their practices and their clients. If your expenses are then off by hundreds of thousands of dollars because you didn't budget it right, that is then its own problem, because it may not only impact, this year, it may impact future years, especially if partners are expecting to wind down or their percentage share. Ultimately, it will change, and the budget is not what it was expected to be, or the actuals do not meet the budget. Then it becomes problematic for managing some of the internal politics and a lot of other strategic items around the firm. So this can get pretty complicated, but when you are really looking at law firms and what you're trying to manage, individual taxes and partner compensation are really most of what you're dealing with. So same rules apply, right? When you have a compensation structure, you cannot make it overly complicated. You have to be able to plan and budget, unless you just want to hold on to the money for the entire year and not pay it out until everything's done. So that tail wagging the dog concept of basically do what you can track is really prevalent here. because you can't have a system that's overly complicated. One, the partners won't understand it and won't be able to perform to it if it's overly complicated. Um, and then two, to plan and predict it will be anybody's guess. And so you run into issues where you've got to hold on to cash until all the final results are in, which then may create problems on its own. So simplicity is key. Simplicity so that you can analyze, you can review, you can think very, very critically about how your business is running and the decisions that you make, and ultimately make decisions that lead to more profits, better transparency over cash flow, and predictability over your expenses, especially your largest expense, which is taxes. So with that, I would like to say thank you to everybody. I think we're just about at 50 minutes here. So let me check and see if there are any questions and anything I can answer for anybody. I can't see the, oh, there's the Q&A. Okay. Is accrual better than cash if all cases are based on the uh, flat fees and due at the start of the case? Um, I no, in that case, cash is better because you have such predictability anyway. So they're ultimately kind of one and the same. For tax compliance purposes, you may not even be able to elect it. But ultimately, if anything changes, um, you you may run into an issue where you're paying tax on money you don't have yet. So that, for clients that for some reason don't pay or different structures that you have, you may run into some issues there. And being that they're so close in in how the dollars will meet the timing of the work being performed, I wouldn't do anything crazy like elect to be an accrual basis taxpayer. Um, but I've certainly seen this come up before, where if you have fees and you're getting the money now and you're not doing the work for many, many months, then you may look into this. Frankly, I don't recall what the outcome was the last. I know it wasn't done the last time I looked into it, but I don't recall if there were certain tax implications where you have constructive receipt of this cash, and that's a tax concept. So even as an accrual basis taxpayer, if you're not expected to give it back, you may have to recognize it anyway. So all the reason to keep it simple in the theme of the presentation. Um, let's see. Office uses QuickBooks Online to track our income and expenses and pay bills. What AI help reconcile it? And QuickBooks Online has great AI tools to reconcile books. So they are available in there. You connect your QuickBooks to the bank accounts, and then the bank accounts just pipe in the information, and QuickBooks will all but automatically code it for you. You can set up rules in QuickBooks and tell those rules to apply automatically. So many times you won't even see certain transactions come through. Otherwise, they all just come up for you to review, and they generally will give you a suggestion of where to code it, and you can put it in that way. If you're going to integrate with your outside time and billing system, there's ways to do that separately, but generally that's going to be just knowing which reports you can get from QuickBooks that should match into your time and billing system. So generally, you don't even need an outside tool or AI. There's so much embedded in QuickBooks right now, and they are growing that tool set every day. So I would continue to look at that. And there are a lot of great online tutorials for QuickBooks that you can look at. There's a lot of great, QuickBooks Pro experts out there that can help with things if you're getting into a project. I think in many cases, Google is going to be your best friend if the Intuit site and help center is not able to facilitate. Oh, and they also have a good call line depending on your subscription. You can call in, and they're hit or miss. Sometimes they're really good, and sometimes they're not. But if I feel like I'm not getting great advice, I call back and generally will land with somebody who I feel comfortable with. Um, are there any law firm building programs that I recommend? It's a weird environment out there for billing programs, and depending on your firm size, it's going to change. But I really love the keeping it simple. And one of the simple softwares out there that I use relatively frequently is TimeSolve. I like. It's a good one. Centerbase is one that's really growing in popularity out there, and those are for generally smaller firms. For mid-sized firms, the environment has changed a lot. There are some key softwares out there that have either been bought up or are really changing or trying to really reinvent themselves. And so it's kind of the Wild West out there. And for small firm or mid-sized firms, 20 to 100 attorneys, you don't know whether to go upstream or downstream because what's in the middle is really, really it's unknown as to whether it's going to be good or effective. But I'm happy to talk through it more if you want to shoot me an email or give me a call. But there's some decent softwares out there. I think, again, the mantra being, keep it simple, keep it separate. I don't like the integrations unless they are integrated systems on their own. I like to do my own transaction and reconciliation just because I find it leads to too many issues and challenges. So that is, I think, the bulk of it. I think that covers all our questions. But as I said, if anybody does have any questions or wants to talk about this a little bit more, I am happy to do it. So please feel free to reach out to me over email. I think I put my phone number on here. You can call too. But yeah, I really thank you all for your time today. I hope this was very valuable and useful and insightful to you. And enjoy your day. Thank you.
This concludes today's presentation. Thank you so much, Derek, for spending an hour with us and educating our members on financial planning. And thank you so much to our audience. Have a great day, everybody.